Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next maybe 25 minutes, let's call it, here on Options Guide TV. To start with, we looked at a Tesla trade on Wednesday's show, and that didn't work out. That quite simply. We're going to come back and look at that Tesla chart and talk a little bit about a forecast going forward. But bottom line is there's not much to show with the trade. There's nothing left. The premium that we paid for our position is worthless at this point in time. So I'm going to start by looking at the SPX. We had a good trade that we put on this week, and that's going to lead into the VIX index. I'm looking to get short the VIX index heading into the election. So with that said, I'm going to jump right into it. Let's go to the Tradier Pro software. We're going to start by looking at the chart in the SPX and talk a little bit about what's going on. Okay, so if we go all the way back to the big downturn in August, what we are seeing is a wedge pattern forming in the SPX. And to me, that is something that is a springboard. It just kind of means the market, and this is the way I kind of feel about the market. I think the wedge pattern matches the way I feel about the market, for lack of a better way of saying it, in that the market wants to go higher. SPX at 58, 55. We're up 45 points today, which is a good amount. And we saw on Wednesday that the VIX index, which is now trading at 18.5, was trading north of 20. And what's going on with the bond market situation, and more importantly with the election, it seems like there's been a lot of focus on the election date. And people are paying more attention to that than they are the actual economic news. But the fears of inflation are tamed, it seems. But then the bond market and the 10-year yield starts going higher. So very weird scenario that's going on. And all the pundits don't really have a good explanation for it. So they say it's because of the election. And who knows, maybe that is the correct statement. But when I look at this chart, and I see this wedge pattern, the market doesn't usually stay within that wedge for very long. Eventually, it's going to want to break out either hard to the upside or to the downside. And I feel like the election being so close on the 5th, that is what the market is waiting for. And then it's going to decide, and not only the election, not the election day, but for them to have the final results, which could be a day, could be 2 days, might be a week, might be a month, right? At this point in time, after the election, the whole process and everything's been turned up on its head. And we've had this before with presidential elections that have taken a month or longer to actually get the results when it's such a close race. Okay. So no regard to who's going to win or not. I just think we need to get that past us, and then the market can decide which way it wants to go from there. Now, the VIX is holding up the marketplace, also showing that there's still uncertainty. And once again, I think it comes from that election date. So right here, if I were, and I'm not going to make this a paper trade, but if I were to do anything in the SPX, vol is a little bit high, but I think I would actually buy a long straddle. Especially after the move up that we had today, because we came down to the bottom of the trend line, and then now we're bouncing back up, and we're like fulfilling our wedge pattern, which I can't draw these lines. I can't keep going out. I just zoomed in. But if I were to draw it, you'd see that, it's really playing out since that low that we had all the way back here in August. So the way that I'm choosing to play this trade is I'm going to go and do a VIX trade, and then I'm going to come back and I'm going to finish up our SPX trade, which we had many opportunities to get out yesterday. Would have definitely got out. Our target was on the low end, down around the 5,800 level. We hung around that. There are just tons of opportunities to get out of the trade, and we would have done so and had a real good winner. At this point in time, though, it's above our strike, so it's not going to finish right where we want it to finish. But Thursday's move to the downside would have been more than enough to make this trade probably a tripler that we put on Monday. Okay, so let's go and let's finish my thought with the VIX trade and make that the official paper trade going into this weekend. Kind of sad that I had the plans to do the VIX trade yesterday, and I was really hoping that the market was going to open down today just to make it a little bit more enticing. But obviously with the VIX, that's the volatility index. I wrote a whole article in my X.com profile. If you want to scroll back, it's called Decoding the VIX. That talks about all the nuances of trading VIX options. I put this position on in my account yesterday, and I went back and forth on if I wanted to do a butterfly or just get bearish and do a long put spread. And I decided to just do the long put spread. On the call side of things, if I thought the VIX was going to go up, which means the market would tank because it's an inverse relationship, I would be looking more at a butterfly. But on the put side of things, the way the VIX works, it's a little bit the skew of the option contracts to the downside because VIX is a volatility index. So basically, to be blunt, 10 is almost like 0. The VIX very rare. It will go below 10 with its new calculation or whatever, but it very, very rarely breaches the 10 level on the downside. Mainly because that would imply if the VIX actually went to 0, that would mean there's no volatility in any of the 30-day SPX option contracts. And that obviously is just not going to happen. So that's why I decided that I was going to do a long put spread in the VIX. And here's the trade that I set up. And yesterday it was a little bit more enticing, but it hasn't moved too much because the VIX trades off of the futures contract more so than it does off of the actual spot index where this market is at. So let's look at the November contract. And we're seeing that the VIX right now, the spot, the actual index is 1846. And one way, if you're looking at maybe we're close. Okay, so the call option here on the 18 level is 221, and on the 19 level is 218. Okay, so the VIX option contracts track the future, and the future is somewhere in between that, and the market is right at 1850. So it might be very similar to where the actual spot index is at right now. And here's what I'm focusing on is that the 18 strike call is the most expensive one here, where the 19 strike put is the most expensive one there. So that implies that the in the money amount on the call and the put switches between 18 and 19. And I know that it's very odd that we can't get a quote from the Chicago Board Option Exchange on what is actually driving the futures prices. If you do put in delayed CBOE VIX quotes, it will come up, but from time to time, it's kind of janky. So what I usually just do is you're using the combination to put call. It's actually called put call parity, but that's what you're using to try to figure out exactly where the VIX is at. And I digress. Okay, the market is fairly close to this. That's where the futures contract is at. This is the November 20th expiration. Double check that because I've had a problem with that recently. 11:20. This is the standard monthly expiration. This is the third Wednesday in November. And a big thing about this VIX index is that, or the expiration that I chose, is that I'm giving it enough time for the election to play out. I'd rather trade the normal monthly index in the VIX. It's where all the volume is, where all the open interest is at. And you'll notice that if you look on the Tradier Pro chains, you see that these are weeklies, and that's shown by VIXW, and then you get a green VIX, which is highlighting that that's the standard monthly. And I love the way the chains are set up inside the Tradier Pro, and that's highlighting that to me, and it's showing that this is where that expiration date is. And if you look at open interest, you see just massive open interest, especially now, considering what's going on in the markets. So I feel like I can trade at the midpoint. Always bid-ask spreads are fairly wide, mainly because there's just so much implied volatility. But here's the trade that I set up in my own account yesterday when the VIX was a little bit higher, and the future were too. All right, so right here, we're going to be buying the 19 strike put. And with that expiration, got 26 days remaining until that expiration date. And then we're going to sell the 16 strike put, and we're going to hit that bid on that trade. So at this point in time, you're buying the 19, selling the 16. We're paying $1.63 for that. Now, ideally, I'd like it to be 50-50, and that's what it was on yesterday's. But I'm going to stick with this because this implies that we want the VIX index after the election to drift lower and go to at least 16 or below. Now, I don't anticipate the VIX getting down to 14 or 13. It could happen. You would need a fairly strong rally in the marketplace for that to happen. But right now, I do think what's really driving it is this election, this known event that has an unknown outcome. And once we get rid of that, even if the market just stays where it's at, I do anticipate that the VIX will start drifting lower. It's a mean reverting index. It wants to be down around that 15 level. The VIX, when it spiked up to 20 on Wednesday, a lot of people were getting a little bit nervous with the marketplace, but it's the VIX in October, and that will happen. So this is a total play on the election, a total play on the fact that, honestly, after the election, and I've said this more than once on Options Guide TV, I do feel like the VIX just wants to, or the market wants its handcuffs off, and it does want to go higher. The economy has been strong. A lot of focus has been on the jobs front, but earnings have been strong once again, and we're going to get a lot of news next week because all the mega cap, the Magnificent Seven are besides Nvidia, are all announcing next week. Almost all of these mega cap tech stocks are announcing next week. So we're going to learn a lot of news going into this, but I still think the VIX will remain a little bit higher until we get to that election date. All right, so 163 or 161 is our, let's put it right there. Let's make it 160 because I do think that I would put this in at 160 and try to work it, but that makes the math simple. You're 3 points wide. The max upside is going to be 3 minus 160 or $1.40. And this is going to be our official paper trade. If I'm putting this trade on, I am using speculation money, right? I do not, I got to be willing to lose 160. Let's just put it that way, because I'm going to let this trade ride. I'm most likely not going to adjust it. If there's an opportunity to adjust, say it's going against me, it's trading 22.23 with a few days remaining to that expiration date, well, I may adjust it then, but the scenario would have to be perfect for me to actually put an adjustment on. I'm going to do this trade, and then closer to the expiration, 5, 6, 7 days, I will look to close out the trade. If I get an opportunity early, say the election does happen on the 5th, and we get the results right away, and all of a sudden you turn around, the VIX is trading at 14 or 13, heck, I'm going to close it and just get out of the trade. And that's a beautiful thing, is that if the market is going a little bit up, the VIX is going down, the implied volatility is also going to go down on the options. So fun trade. I love trading the VIX. I pick my spots. I like to trade at the more extremes. I like to get short volatility when the VIX is high, and I like to get long volatility when the VIX is low. So it's not something that I would trade weekly or daily. I'm trading it every once in a while, and every couple of months when I see an opportunity in the VIX. But I love the VIX index, and I love to trade it if you can understand the nuances of it. All right, so that's the official paper trade. It is at 160 right now on the net debit. I'm going to take a screenshot of that. We're going to come back on Monday, and we're going to look at that trade. Now, let's go back and talk about our trade that we put on Monday. It did really well, as a matter of fact. It followed The only downside you could say is that we got this update today that put it outside of the range. But if you didn't get out on Thursday, you know, honestly, you got the stupid award for not getting out. There's no reason to not get out. It was at the short strike of our spread. And we'll go and we'll just put it in here. Excuse me 1 second. Yeah, we'll just look at it. Okay, so I really struggled with putting these expirations together, and I know there's a couple of people out there that were watching. If you have any comments or questions, please put it in the show. But I don't know why I wasn't getting the right date when I was trying to set this thing up. But now we know the date because there's it no longer lives after today, the 25th, and I am pulling up the strike prices that we use. So give me 1 second here. My eyes aren't what they used to be. And 50, when we put the trade on, we were at 58.30. SPX is 58.51. So I mentioned the fairly decent down day on Wednesday, also continued on to Thursday, and now we're seeing a little bit of a bounce back up. So 58.51 is above our first strike in our put option, which would be a bad thing. If you rode it all the way to today, you would have lost your money, bluntly, on that trade. So we paid $2.80 for this. 1 second, I'm trying to find the this the trade. Okay, here it is. Yeah, $2.80 was what we paid for it. When we put the trade on, the market was actually, when I took my screenshot, was 58.27. We went out and did the 25th expiration. We bought the 58.25 strike. We sold the 58.05 strike. We did that one twice. And then we went down and we stopped short. We didn't go 20 points. We went 15 points on the next one, which was 57.90. And we bought that. All right. Well, we're still getting 82 cents for that. That's not bad. You know, the SPX really holds on to its premium. Now is going to be a huge rate of decay, but we are obviously out of the money, and we're actually outside the one standard deviation move on this trade, but we're still seeing 80 cents. So if you could get out, you would, if you stuck in it way too long. But if we go all the way back to the chart and we just zoom in on that area of the chart, let me grab it over here. Let me grab a tight window here. You see that we came down, and this was Wednesday, this was Thursday, and we traded all around that short strike. So 58.25 is where our strike was at. It went all the way down. It actually dipped below all the way down to 57.62, which we didn't mind because we modified the butterfly, and then it came back and it closed right around 5800, which is very close to our middle strike. And then we hung there all day long on Thursday. So like I mentioned, tons of time to get out. You could have sold it for about $6.50, $7 is what I saw a couple of times if you wanted to close out the trade. And if you didn't, well, then shame on you, because now the market is back up and you would actually be down on that trade. Rule of thumb with any butterfly that I'm going to do in the SPX, if I get to Wednesday or Thursday for sure, if it hits our short strike, when we're targeting a downside, I'm going to get out of the trade. I'm going to have realistic expectations. If I put it on for $3 and I sell it for $5, no worries. I mean, the max upside was 20 points, but I can't say I never, but very rarely have I ever had a SPX butterfly finish right on the strike. I have managed some before and got lucky a couple of times, but that's a couple of times in 20 plus years of doing this. So I always, if I look at it, if I can double on a butterfly, I pay $3 for it and I can sell it for $6, I'm going to get out. That's simple. That's straightforward. And I think we're going to be a little bit short and sweet. So we're going to finish up a little bit here. Let's see if we have any questions or comments. 1 second on the VIX trade. and when we can pop back out here. And I think that's going to be it for this edition of Options Guy TV. Please go check out my VIX article that's inside my X.com profile. My handle is at Brian Overby, at my name. That's simply. Follow me on Twitter. I will sometimes put in trade adjustments. I like the VIX trade. Like I said, I mentioned I put it on my account yesterday. I think I did it. It was a 50-50 trade, and that I paid $1.50 for it. And I had $1.50 of upside. Now it's at $1.60. It's only a dime higher. VIX is down about 50 cents from where I put it on yesterday. And that's it for this edition of Options Guy TV. Earnings next week. You want to tune in. We will do some earning trades and around all these mega cap tech stocks. And that's what will be the theme next week. So stop in Monday, 11 a.m. Eastern time. See you then.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.